If my structured note has a buffer against losses of 20% or 30% or even deeper buffer, why does my value go down and change as the market goes down? Aren't I protected from that? I'm Sean Jones. I am the founder and president of Jones Fiduciary Wealth Management, and I'm going to tell you why, and hopefully show you why, structured notes value change over time. So we like using structured notes instead of bonds in most cases because historically they're going to perform much better than bonds over a 5, 10, 15-year period of time. And the reason is because they're tied not to the bond market but to the stock market, yet they maintain, if you structure them the way we like to structure them, they maintain the same type of protection against fluctuations in the stock market. And so this is just a very simple, obviously, sketch that I scanned in here. And we're going to assume this is a 5-year structured note that has a 20% buffer, and we're going to say it has 100% participation. And so we can see that early on here in this, life cycle of this structured note, we started out at par value, and the market, which is this more volatile black line, loses value quickly. And we can see that our note also loses value, but not as much. And then as the market races to an improved valuation, our note improves, but it's not following it at 100% the way this 100% participation would suggest. And so what's happening here throughout the whole value is that this is a liability on the bank's balance sheet. So if this is JP Morgan or Citibank or Bank of America, they owe you this money, right? They've borrowed money from you on a 5-year basis. And so the values that are on your statement, you may be able to sell them to a third party for a higher or lower value. You can always have the option to try to get a different value than what the issuer is offering. But on your statement is what the issuer is offering to buy back their debt. So if you want your money back that you lent them in the first 6 months of this bond, they are not going to give you your full value back because that wasn't the agreement. And they figure if you need your money back already, then you probably are maybe a little bit desperate. And so they have every day, and depending on the bank, sometimes every week, some only as little as every month, but they are going to put out a blanket offer for the notes that they have out on the street. And so that's what's showing up on your statement. If you want your money back right that day or that week or that month, that's what you're going to get. That's the value of it. That's the current value of it. And you might say, well, this has 100% participation and 20% buffer, and the market's only down 10%. Why are they offering me back something that looks like I would get back only 95% of my money? The answer is that those guarantees are only valid on the 5th anniversary of when you purchased it. And so that's the guarantee. The guarantee is that at this time frame, the value of the underlier and the value of this index are going to be, they're going to share the same value. So only on that last day are you going to actually know the exact amount that you're going to get. And it's going to be based on, the guarantees of the individual note. Now, I will say that in the first year, the difference between the underlying performance and the note itself is the largest it's going to be. As you get closer to the end, the issuer knows that they can't just completely lowball you on buying the debt back because you're just going to probably wait. And so their offer gets much closer to what the actual value is going to be. And that has it is affected some by what the current interest rates are. So if the interest rates are low, the differences between those two are going to be less. If they're high, the difference is going to be more. But on that 5th anniversary, you will get what you are guaranteed based on the prospectus of that note. So I hope this helps you understand the difference between the statement value and the eventual value and specs of your structured note. Give us a call if you have any more questions. We'd be happy to walk you through that. All right. Thanks a lot. Have a great day.